All right. Welcome back to another episode of the update for Living Off Income Portfolio. So, for those of you who joined for the first time, this is a series where I record my income portfolio during a drawdown period. What it means is that I record myself withdrawing from it and then kind of document along the way. The reason I'm making this portfolio journey is due to when I first wanted to retire off the income portfolio, I couldn't find a good example of people who are doing it, doing income portfolio and then doing the drawdown period. Usually, a lot of them are during the accumulation phase, which is tend to be the norm. So I thought that I would be that piece of data myself. So hopefully, if you enjoy this kind of data, subscribe and follow for more. So what I'm doing is I'm gonna show you my main portfolio, the drawdown, how much I withdraw each month, and the growth of it, and then I will compare it to other popular ETF like a VFV, which track S&P 500, XEQT, which is kind of like a global diversify index, HYLD, which is a popular income ETF, QQC, which is a Nasdaq ETF. Okay, without further ado, let's go take a look. Okay, all right. So jump right into the numbers. So this is the main portfolio. Honestly, not too much have changed since last month. The portfolio growth kind of dropped from last month. Right now we're sitting at 1.116 million. The withdrawal amount for this month hasn't been decided yet because I'm gonna have to wait for all of these to show what's the what's the amount that they'll be giving for distribution for the month. It is December. However, we're starting off tracking the year on the 14th, so this is actually the month 11. So the full year is gonna be in January. So just a little recap. I think Blossom had kind of like a yearly recap for the portfolio. So funny enough, the best performing for the year is actually the fixed income. These fixed income, I think when I first bought them, they were quite low and then they're paying a good yields as well. So they've been appreciating a lot this month due to interest rate kind of trending down. I think the CPI came out today in the US. The reason that we focus on US is because US tend to have the effect on the global stock market. The CPI, which is the inflation rate, came out quite a bit lower than expectation. Let's just look at it real quick. So this is the inflation rate coming in at 2.7. I think the expected was 3.1, and then it came in at 2.7. So that's a big beat. And I think the core CPI is 2.6 to 3%, which is also a huge beat. October we didn't have any data because the government shut down. This is actually quite a good news. Two things, right? Okay. So if the main thing that drives stock markets and spendings is the how much interest rate are currently. And interest rate being quite high in 2022, that's why you see the market kind of collapsing a little bit during that time, and then slow recover as interest rate come down. So the Fed kind of in the mode where they're not sure if they should cut rate or not. If the inflate because they're worried that inflation is going to tick up again. But now it keeps showing that inflation is coming down, so it kind of incentivizes the Fed to be able to cut rate in the future. And then when rate cut, business more flourish, people are spending more money, etc., etc. So this is actually good news for the market going into 2026. Of course, this is just one factor. There's probably other factor that you need to think about as well. But this is a good news for the market overall. So yep, so the fixed income been doing really well. I expect this to keep doing well. They're not meant to be a forever hold because when interest rate go up, these things gonna get hit really hard. As you can see, these back in 2022, 2023, they were basically like $10 each. One thing about fixed income is that they have a cap price of about 25. So that's as much as they're gonna get to. That's as high as they can go. 26 maybe at most, depending on their maturities and their rate reset schedules and stuff like that. We won't get into that too much today. Okay, so the margin portfolio is probably the most versatile portfolio we have right now because we got assigned on the BMNR and HOOD. So I got assigned for quite a high price. So this is actually the loss leader of the portfolio right now. They don't pay any yield. We do sell cover call on them here and there, so we are getting a lot of premium from them. But if I have to just isolate to these two positions alone, we probably lost maybe on a book loss of about 20,000, which is quite a bit. If we didn't have that, we would be close to all-time high on the margin portfolio, which is great. Hood in terms of like ticker Y Hood, honestly I'm not worried because I think in the long run Hood has a lot of room to grow in terms of like prediction markets, etc., etc. BMNR I kind of got in because I think Ethereum has a lot of future. But then again, with the crypto, there's a lot of other factor that I'm not familiar with. So this is probably the most shaky position I have. But again, I used to trade option quite aggressively. And then one thing that I learned is that you have to size your position accordingly. So BMNR is actually very, very small part of portfolio. So let's say if they were to collapse, worst case scenario, it will hurt, but it wouldn't make a giant impact on the whole picture. It will still suck though, obviously. So yeah, so that's the update. Living expense wise, everything's going according to plan. I think for the year we went up maybe 12% total for the cash. Sorry, for the for the capital appreciation perspective, and this is from us withdrawing every month from it. Okay, so I think that's about it for this one. Let's go look at the VFV portfolio. So this is where I compare the whole portfolio with the hypothetical S&P 500 portfolio that I start tracking at the same time, withdrawing the same amount, and then I kind of want to see how the path go together, and like which one, if I were to go a different route than my main portfolio, how would it have performed? So the main portfolio is sitting at this amount, and now VFV is sitting at 1.025 million. Honestly, it's quite surprising because of that cover call has a lot of drag on the return. When I first started tracking, I would assume that S&P 500 gonna beat all of them. S&P is gonna do better than XEQT, do better than HYLD, do better than my portfolio because it's a pure growth portfolio. But so far, the result is quite surprising because VFV is actually lagging behind everything else. Granted, this is a very short time span, so I wouldn't draw any conclusion from it because we've only been tracking for close to 2 years top. So in the future, in long time span, like 10, 15, 30 years, it could look very different from now. So I wouldn't draw any conclusion from it. So in December, we sold 20 shares to fund our withdrawal. So far, since start, we sold 280 shares total. At the current price, if we were to withdraw it now, based on the amount that we withdraw last month, we would have to sell about 21 shares. So how it works is that this is a formula right here. So I basically do like a fixed distribution and then divide into 12 months period, and then minus that with the withdrawal amount, then I sold share to cover the rest. So far, this is the amount of VFV. Next is XEQT. This is actually one of the more popular, becoming more and more popular every time I see it. It's a global diversified portfolio, so you have allocation to US, Canada, and the rest of the world as well. It's like an all-in-one pit stop, basically. You want a full diversification of investment, this is the one. XEQT actually did a lot better than expected. Initially, I thought that S&P would do the best because it has a good concentration on tech, and that tech grew a lot the past year. But XQT actually did really well and then beat VFV by a decent 5% almost, I think. So XQT, this is the amount that we have right now, 10.08. Again, this is hypothetical. I get a lot of questions where, you have all these portfolio. No, I only have the main portfolio. The rest is just for comparison and experiment sake. Okay, so XQT in December we sold 104 shares to fund the distribution. XQT, I didn't really, the how I calculate distribution is a little bit tricky because they pay quarterly and every time the number kind of varies. So I have to do it manually for these ones. So I try to leave it in the comment over here just to kind of make it as accurate as possible. Again, I do a lot of these by hand, so if I do make mistakes, I apologize. Just point it out for me if you see one. Okay, so that's XEQT. Next one is another popular ETF. HYLD is from by Hamilton. It's basically US, I think US overall with a lot of sector mix, and then they do a cover call on top with 25% leverage. Personally, when I first started the experiment, I assumed HYLD would do the worst because it's a cover call. You pay quite a lot, and then how I understand is that every feature you add to the ETF, it will create a drag on the return. However, HYLD beat expectation. It actually beat VFV by 35K. So it's quite a pleasant surprise because I would assume that this would do worse, but it actually did quite well. Liberation Day, it did drop the hardest down to 700K. Of course, this is just the number I saw. For the intraday, it could be lower. I'm not too sure. So HYLD is a little tricky for a distribution. This month we bought 386 shares because they pay so much. And then I didn't think it would be fair to just do a full amount. So what I did is that I minus 10% tax upfront to kind of save it for the future tax that I have to pay, but the hypothetical tax I have to pay. And then whatever left, I use it to withdraw the same amount, and then the rest I buy more shares. So as you can see, the share is going up every month. Right now, we're sitting at 70,693 shares. So far, since start, we bought about almost 4.6k shares more. So we actually had a lot more share than we first started. Okay. And then the newest addition that we added last month, someone pointed out that I should add something more tech-focused ETF. So I decided to add QQC, which is the Nasdaq, basically just a Nasdaq index ETF. Of course, Nasdaq doing really well as well because it's tech heavy. Tech usually grow really fast. Doesn't have any dividends though, which is fine. So I did. So basically, I do a QQC. I retrofit all the data. I did make some mistakes, but I should be all fixed now. So this is the amount that we retrofit into. They do pay some dividend. Again, it's quarterly, so I have to do it manually. Quite a bit of work, honestly. But I do want to see how the Q would perform compared to the rest. So I think it was a good upfront work to kind of see the data in the long run. So since beginning, we sold 1,300 shares on the Qs, and now we're sitting at $1,093,000 hypothetical portfolio once again. Okay, so with all that, let's take a look at the side-by-side data from the beginning. So I have them aggregated over here. Okay, so I just found out how to do a combo charts on Google Finance. So now we have this wonderful, beautifully presented chart over here. So back then you can see that we just have the main line of how the portfolio is performing. Now I overlay it with the cash amount, which is the light blue part over here. This is how much cash we have, and then the light red over here is the amount of cash we withdraw per month. So you can see how much we withdraw per month from the beginning, and then you can kind of take a look and comparison with the chart. So you can see that in the beginning, when we first start tracking, we're starting out with $26,000, and then we see a big drop over here during the April. This is basically during Liberation Day. I decided to basically take out a lot of the cash and just kind of dump it in the market, leaving about 5,000 for emergency fund. At the time, we back in Canada, so we thought that I have some stability. I don't mind having a little bit lower emergency fund, so I decided to pour it into the market as much as I feel comfortable at a time. Turned out to be a good idea. Of course, it could have gone really bad. It could keep dropping, but so far it's been okay. And then I've been trying to build back the cash reserve ever since. So right now we're sitting at about 16,000. We haven't shown the distribution this month yet again because they haven't announced. So as you can see, this is the side-by-side data for each portfolio. The Qs have been doing really well, and then I think we just slowly passed the Q at the last 2 months over here. Of course, like I said, this is a very short time span, so things could change. The Qs are, as expected during the bull market, the Qs are performing the best. Um, the market been pretty shaky the past month, but I wouldn't really call it a crash or anything. I think it's just the volatility of the market. I think the true test will come when we had a long sustained bear market like in the 2022 or even like the 2008 to 2012, those kind of thing is going to be a true test to see how everything would perform. Okay, so that's basically the number. Um, I want to talk a little bit about some question that some people message me. So I do post the info a week early on Reddit and Blossom. I did get some personal message asking about, oh, why don't you invest in, Evolve Bank or UTES, all these things. So I want to show you something. So I do trade a lot of options before I decided to be more hands-off. So let's take a look at Bank by Evolve, right? So this is Bank by Evolve. Basically, what they do is they do a lot of financial institution and sell cover call on it. So Bank, I think they use leverage. I'm not too sure. Okay, so Bank, you do use leverage. The total fee is 219, 2% and 2.919%. Quite high, but of course, keep in mind that a lot of these come from the margin fee. So the 1.36, a lot of these probably margin fee. Evolve tend to be a lot more active in the trading, so that you do pay a lot more than usual for the trading expense ratio. So okay, my assumption is 1% margin. The other 1.1% is probably the underlying fee. The fee is quite high, but of course, with margin, that kind of given. But I want to point out is that the assortment of the ETF. Okay, so you can see that they hold pretty much equal weight, all the banks and all the insurance providers and stuff. So, and then they do pay 14%, which is quite high. It's very high distribution rate. So what's the problem? So I want to preface by saying that this is what I don't like about it. I'm not saying it's bad. It could work for some people. It might not work for some people, and it doesn't work for me personally. So let me show you what I'm talking about. Okay, so this Royal Bank, one of the best performing, like probably had one of the higher volatility bank in Canada. By high, it's still very low. Okay, I'm just trying to, in terms of price movement, it's probably have more than something like Bank of Nova Scotia or something like that. You know what? Actually, let's look at TD. Why not, right? TD is probably have a pretty good movement as well. Probably have more than Royal Bank even. So I go with the 30 days. So 30 days option chain. So basically it's 30 days out. Usually when you sell option, you're probably looking at 30 to 45 days option, time span period before expiration. So look at TD, okay? TD currently sitting at 127. Okay, this is going to be very number kind of oriented. If you bought, feel free to skip or whatever. So look at the TD. Okay, 1 month out, right at the money, you get 134 per share. So basically, option lot is 100 shares per contract, right? So with TD is 127.7, right? 127.7 times 100. So that 12,000. You get 134. Let's just took the middle pack over here. So 134. So 1.34. Sorry, 1.34 100 shares divided by 127. So it's 1%. You get 1% per month selling at the money, and assuming you selling at the money for the whole position, you get 1%. TD itself pay 4%. Okay, and let's assume margin, you get up to 7% total distribution. Option, dividends, assuming nothing goes wrong. So my question is, how do you get 14%? Like, where is it coming from, right? That's what I'm always asking is, where do you get the volatility to sell the option to generate 14%? And then, of course, I'm not claiming to be an expert. There could be a lot of things that I don't understand, but this is how I understand it. Also, the option chain is not that liquid for Canadian stock, but I'm assuming that fund ETF has I think how to say in layman term is they go directly to the provider and then they strike a deal to kind of get the custom option contract. So I'm not going to talk about that too much. But the thing is, with all this scenario, you probably get 7-8% tops, but then they pay 14%. So I'm not too sure where it's coming from. So my assumption is that they will come from, but they have to sell some shares to pay out to be able to sustain this 14%. Um, and then I can see this being worked well for some scenario. Let's say you're 65, you're retiring, and then you need to get like higher distribution of cash. So I can see you doing this as a withdrawal strategy. I can see that. Okay, so but for me personally, with a 50-year time span, I don't see this being too sustainable. It's good right now because Royal Bank goes up in price. So let's say Royal Bank the past year been going up in price, right? So bank probably doing okay. But my question is, if it stall, the 14% is unsustainable in the long run. If your time span is 10, 20 years, I can understand that you might think this is a good withdrawal strategy, and then it could be a good withdrawal strategy, but for me, it doesn't work. And then another one is UTES, which is basically sorry, Canadian utilities, and then again with margin. Okay, so the fee is quite a bit lower actually. I'm quite surprised because it's enhanced, so I'm assuming that they would use the margin, but anyways, so it's 1.14% for the fee, which is good, lower. But then again, utility also have very low volatility. Okay, I'm looking at Fortis here, which is a very very well-known Canadian utilities. At the like this is basically at the money again. you barely get any premium, but UTES is paying 17%. Like sure, utility pay a higher dividend rate, like Enbridge might be paying 6%, etc., etc. But I just don't understand, like, how do you get 17% from? Think of premium as insurance policy, right? Let's say if you are an insurance provider, someone come to you, let's say like a gentleman, doesn't drink, doesn't drive, doesn't smoke, living super boring life. You have to write a coverage for his life insurance. You probably okay, you know what? You don't do any crazy stuff. You can pay $20 a month on premium. So think of that as utility bank, very boring, very stable, very very how to say very stable in the long run. Had long track record, everything's good. Stable cash flow, stable growth. That's basically the gentleman who doesn't drive, doesn't smoke. So now when you look at Tesla, it's basically a guy who, party, going out, driving sport car, doing 360 backflip, all the Red Bull crazy stuff. So when they come in asking you to write uh, a life insurance policy for him, you can be like, you know what, you gotta pay like 1,000 a month because you're doing so many crazy stuff. Anything could happen to you. So then when you see those ETF, those tech ETF writing cover call, paying 10, 15%, 20%, you can understand where they're getting it from. But with UTES, with bank, it's more of a withdrawal strategy, more like a drawdown strategy at that point. So I don't think that premium alone can sustain the amount that they're paying out. And again, I'm not an expert. I could be missing something. If you do, please educate me. I would love to understand more, of course. And again, I'm not saying these are bad. I'm just saying it doesn't work for me personally. Like you should do your own research and see what works for you. But that's just what I want to talk about and then explain why it doesn't work for me. Okay, so now let's go to, sorry, there's a lot of number boring stuff. So now let's go to the year-to-date update. Okay, let me move this one a little bit here so you can see. So this is the number. Month-over-month change, we're down quite a bit, 41,000, we're down. So we can see that our betas is quite higher than the VFV and the QQs. We're down 3.6%, the rest are down quite a bit lower. Year-to-date, we are quite green though. So, this is basically the amount green after the distribution in the price appreciation perspective, and this is including distribution. So far, 2025, we withdraw about 50,000 to live. So yeah, everything's going okay. I wouldn't worry too much. 2026, again, there's this saying where you don't want to fight the Fed. So if the Fed try to stimulate, doing QEs, cutting rates, I feel like despite all the bad headlines and stuff like that, I feel like after everything settled down, I think will be a good market overall. Is it a bubble? Nobody knows. You only know if it's a bubble in hindsight. So I think I'm sure a lot of you have seen that there's like a info where if you miss the best 10 trading day of the year, you kind of miss out on most of the return. So I think unless you have good reason to, I think I would just stay invested. Of course, you want to research on what you invest in to make sure that you give yourself the best chance to succeed. And yeah, I don't want this video to be too long, but let's not talk about any more on that. So 2025 goal, we read 8 out of 12 books. I don't think I'm going to be meeting the 4 books goal in less than a month here. Trying the restaurant, we killed it. Cooking new dish, we killed it. Duolingo, we already killed it, so I'm not even going to update that. We way above. Emergency fund, we're still lacking behind, so we're going to continue doing that in 2026. Hopefully, we can get to 25 to 30K by end of year. Commanding heights, man, I've been so lazy. I haven't even started. eBay listings going really well actually. A lot of listings are start to sell in December. I think people are just in the more shopping mood. So I used to work for a luxury retail store. So I do have a lot of when you work in those stores, you end up with a lot of stuff that you don't really need, but you have anyway. So I'm trying to sell them off. Get those money to pad in emergency fund or something. So in the process of that. Okay, sorry, this video was longer than usual. I hope I talk okay. If you have any feedback, please let me know. And thank you for watching. I'll see you guys next time. See ya.